Hello everyone and welcome to the Bite Size Finance. In this lectures we will be looking into the very important aspects of capital market, that is money market, and within the money market we will be looking into the interbank money market. In this lectures we will be covering overview of interbank money market instruments, benchmark rate, and interbank settlements and payments, and interbank credit assessment. And we will have a quiz. uh, I will add the quiz in the descriptions forum. So let's just start with the overview of interbank money market. What is interbank money market? This is a global market. It's truly global in the sense that it is connecting the entire financial world of one bank to another bank. There are financial centers like in London, New York, Tokyo, where the cross border transactions happens. This is the market where repos are traded. This is the market where unsecured transactions happens as well, particularly the overnight uh, Fed fund rate transactions. This is the market where basically one bank, those bank who have some surplus funds lend to another bank who have a deficit in their book, and through this uh, basically market they maintain the reserve ratios that has been set up by the central governments, uh, central banks, and remain compliant basically. And this market is for a very short durations. Most of the times the interbank money market is for fortnightly or maybe for a couple of weeks, not more than that. There are certain instruments which is used in the broader money market, which has a long durations, but generally money markets is used for short term liquidities like maximum up to 1 years or 12 months. So what are the key functions of interbank money market? So primarily there are two functions of the uh, basically three functions. One is the liquidity management, just like we mentioned. So those bank who have a crunch on liquidity, basically every bank needs to maintain certain uh, liquid funds, or you can say cash, that the bank needs to maintain uh, every day. At the end of the day they needs to maintain certain portions of their deposits as a cash, and uh, and that is set by central banks of each countries. And the bank who have the shortfalls, they borrow it from the bank who has the surplus, and this is the way basically liquidity remains available in the market. The another functions that this helps is the price discovery. And because through these all these transactions, this have some kinds of it creates some kind of a benchmark rate. Earlier it used to be LIBOR. Nowadays there is SOFR that is getting used, and these SOFR benchmarks is getting created because of these interbank overnight interbank transactions. Then there are third functions that is very much critical, is done by the central banks, because central banks basically the primary role of a central bank is to manage inflations, at the same time to boost the economic activities as well. And the central banks generally managed it through the money markets. So basically when there is a boom cycle, then in that case central bank basically tighten the money market by increasing the interest rate if there is an inflations, and if there is some kind of a burst cycle, just like it has happened in the financial crisis like 2008, then central bank reduces the interest rate. Sometimes it goes up to zero, and in some cases it has gone in negative as well in the case of Japan's. So these are the basically three functions: liquidity, uh, price discovery, and third is the monetary policies implementations. Now, who are the market participants in these interbank market? So primarily there are banks, and bank within bank there are two kind of banks that participate in this one, that is commercial bank and investment banks. So commercial banks are basically are the one who are most active participants in these markets, because they have to borrow and lending. The borrowing and lending is done very frequently in the commercial bank, because they receive the deposits and people take loans each and every day. There are millions of transactions that happens in a bank, and through these money markets they manage the liquidity. Also they need to maintain certain reserve requirements, just like we mentioned earlier. They use the interbank markets to meet their daily cash flow needs, and they settle their transactions and maintain the liquidity ratios as mandated by regulators. Then another bank is the investment banks. So basically these banks relies on short-term unsecured funding from interbank market. But after financial crisis, uh, because of some regulatory reasons and some of the volatility concerns, some of the investment bank basically converted into the commercial bank. So there are another entity, that is non-bank corporates. Corporates also participate indirectly in the interbank market, especially the large multinationals that has significant cash management needs. These entities might lend surplus fund that they had, or they can seek liquidity sometimes as well for short-term needs to manage their working capitals, obviously. But after the 2008 financial crisis, there was a lot of reforms that has happened, and there is nowadays very strict credit evaluations process that needs to be done for corporate borrowers. And in some countries it has been restricted as well to not have the corporate entities, non-bank corporate entities, access to the interbank money markets. Then we have the pension funds and money market funds. Pension fund and money market funds are very critical, because generally they do not participate in the market to borrow. They have a huge chunk of cash they wants to invest in. So pension fund, for obvious reasons, they always need some money because there are payouts that is uh, coming each month. And for uh, a pension fund, they receive the funds as well, but those funds get invested for a long durations investment, and some of the funds, to manage their liquidity, they need to invest in this interbank money market. And there are certain mutual funds which basically participate in these overnight liquidity management, because also in the mutual funds there are certain funds which primarily focus on these kind of overnight or short durations funds, because there are people who participate in activity for mutual funds. They need to basically pay out, and all those things are very unpredictable. To manage those liquidities, they basically invest in interbank money market so that they can earn interest as well, and they get the money pretty quickly as well. Then there are central bank. Just like we mentioned, central bank basically participate in the market to regulate the liquidity. At the same time, they push their monetary policies as well. And in some cases, they basically uh, help banks if the banks are in trouble, and they do it through these money market instruments as well. Okay, now there is onshore and offshore market. The onshore markets are the one where the bank work within the jurisdictions of the central bank in the country in which it operates in. So for US, there are Fed, and similarly for uh, European Central Bank manage basically the Eurozone. um, Bank of Japan maintain basically the banks in Japan, and these are very regulated onshore markets. So central bank have full control on the onshore market. On the offshore market, basically they happen in the outside jurisdictions of the central bank, and these happens in a big financial centers where um, the foreign exchange happen, a lot of transactions happens in currencies, particularly in USD. Actually, we will look into how these offshore market created on benchmark or LIBOR, and what was the problem with that one as well. So we will look into the benchmark later on in this lectures as well. We will look into it, but in a very brief detail. But in the later lectures, we will look into the benchmarks and their evolutions as well. Now, the second topic is the money market instruments. So there are a couple of instruments through which basically the entire market work. First is repo. So repo is basically a form of uh, borrowing in which there is a collateral, and this collateral is a government security. So suppose bank A had a need of $100 million. Bank B has a surplus of some amount, and they wants to earn interest on that surplus. If that surplus remains with the bank, they won't earn any interest. And bank A has a need of it, a very short term needs because of regulatory cash reserves requirement or some other reasons. So bank A will ask bank B to provide $100 million. B will say, okay, give me something for security, for collateral. So bank A will submit certain uh, government securities with bank B, and bank B will basically provide $100 million to bank A. Bank A will provide a bit more than 100 millions, because when these transactions happens at the same times, there is an agreement as well. So okay, I'm giving you securities for suppose 3 days. Within 3 days, you for 3 days you give me 100 million. I will give you a security, and I will take that security back from you, and I will pay you 101 million. So you get a profit of 1 million, and I get my security back. When bank B see it, so bank B will say, okay, give me a security of 100 million. I will take the 100 million or X amount of securities close to 100 million. So it might be 102, 105. So a bit more than 100 million. Whatever is the requirement ask, they basically ask for a bit more, because there are credit risks as well. We will look into the credit risk, how it's get assessed as well. So they will take a haircut. So it's called haircut because if uh, So suppose bank A need $100 million, so they need to provide $105 million of securities to bank B, and those 5 millions extra that has been provided to bank B, that's considered as an haircut, because what happens is that within 3 days the yield curve will change, so the values of those bonds might get changed, though these transactions happen for a very short durations, but it can changed in the short durations as well. Okay. Then next we have the T bills. These are treasury bills, or in short it's generally called as T bills. These are a short duration instrument. These are basically issued in 3 months, 6 months, or a year, not more than that. And T bills basically help government manage their short term borrowing. And because this is a government backed securities, at the same time this is for a shorter durations, so there is a very low chance of volatility in the T bills, because yield will be considered consistent in the short term at least. So that's why T bill are generally considered as cash equivalent, because there is a very less chance that the yield will change a lot. And generally for government securities yield is like this. So for shorter durations the yield will be a bit lower, for longer durations the yield will be a bit higher. The reason for the same is, for a long durations you don't know, so there is an uncertainty what will happen in futures. For short durations at least you have a forecast that the situations remains either the same, or it might get changed slightly, not that much. But when things are not good, the situations like we have in today where we know that the inflation is very high, in that case, and we know that these kind of inflations won't sustain for a very long period of time, what happens is that for that kind of a period the yield become inverted. What do you mean by inverted? So short term yield will become higher and than the longer term yield. Generally short term yields are lower than the longer term yields because of the uncertainty in the future. But because currently the situations is volatile, the yield become picked up higher, and for long term securities it becomes a bit lower. So that is called as uh, inverted yield. Okay. And T-bill is mandatory. There are certain provisions basically to manage the liquidity as per the Basel III norm. After the financial crisis there was certain provisions that has been made in the Basel III Accord, uh, according to which you need to there is two kind of ratios. Basically one is the short terms ratio, liquidity coverage ratios, and another one is uh, long terms ratio. Basically short terms is for 1 month, and LCR is used for 30 days stress testing situations in which you won't have access of money market. How will you manage it? So to uh, maintain that liquidity coverage ratios, you need to hold either cash or cash equivalent products like T-bills. So banks generally love these government T-bills because they earn interest. At the same time, they provide the cash kind of securities. Then we have the certificate of deposits. It's generally considered called as CDs. These are the time deposit issued by bank. These have a fixed interest rate. Okay, so T-bill basically do not provide you interest. They provide, they are issued at a discount. What do you mean by discount? So suppose government has issued one T-bill for $1,000, but bank won't get it for $1,000. They will get generally for 950. Okay, so they buy it for 950, but they don't get any interest at the end. of maturity period. So once the T-bills get matured, then they submit the T-bills and they get their $1,000. So this is how basically yield come in pictures. For CDs, you get a interest. So here you properly get an interest like an FD, fixed deposit, but CDs are generally issued in a higher denominations, typically of $1 million or more than that. And banks again loves these instruments because this helps them maintain their uh, long terms. I mean to say that 1 years. So there is one ratios that bank needs to maintain. Uh, these are called SLR or something like that. I have forgot the name. Uh, Net stable funding ratio, NSFR. Okay, so net stable funding ratios, it mandates that you need to have certain kind of liquidity in your systems. It checks the stress level scenarios. So if there is a stressful scenarios in the market for an year, how the bank will be able to remain solvent. And to maintain that, CDs are a very helpful instrument for bank, because if you break the CDs, then also bank gets the profit because they charged a very hefty penalties. And if you hold it for the maturity period, then also banks get basically the benefits because it helps them meet the regulatory requirement. So CDs, banks generally loved it as well. And CDs, because this is an security instrument, it can be traded in the secondary markets as well. So generally what happens is that if you have bought a CDs from a bank, you generally do not redeem that CDs, or you do not try to break that CDs before its maturity. You generally go to the secondary market and sell it, because in the secondary markets you get a better values, because if you go to the bank to break that CDs, in that case the bank will charge you a very hefty amount. So there is a very active secondary markets for these CDs. Then we have the bankers acceptance. These bankers acceptance, basically these are the promissory notes that is issued by bank to manage the import export. So basically if you are from country X and you need to send an item to country Y to some person's B, then in that case you don't know that person's B. You have the goods, persons B do not know person A. In that case the persons B won't give you a payment until unless they receive the good. You won't send your good, person A won't send a good to persons B because it's in another jurisdictions, they don't know it. The bank will come in between. So bank will say, okay, hey, I will give you a guarantee that you will get the payment, and these are called promissory note. No matter what, I will give you the payment. And these are traded as well in the secondary market. So you have a need of cash currently, you get a promissory note from the bank and you sell it in the secondary market. Obviously you won't get the entire values, but you will get close to that values. So if you need a fund immediately, you can sell it and basically get it. So this way basically bank manage the trades between two different jurisdictions as well, and these are very profitable for banks as well. Then we have the benchmarks. So what the benchmarks does is that it sets the tone of the economy. Basically through that benchmark you will be able to gauge where how much interest that needs to be paid for a mortgage, because and these benchmarks is decided based on the interbank transactions that we talked about earlier. So there are LIBORs. So there are a couple of benchmarks which is very critical. One is LIBOR. LIBOR is London Interbank offered rate, and this is a global benchmark which how it used to work is that there are some banks which used to sit together and provide their estimations. So that was just an opinion. There was no concrete uh, datas from which it was taking off. It was just an opinion. That opinion was submitted by these banks that okay, these are the rates through which I'm lending, and this is the rate through which currently the lending is happening. And after doing the average of those all those lending, uh, weighted average, obviously the fixed rate used to get set, and these used to happen for all the currencies, most of the currencies like USD, euro, pound, uh, Japanese yen, all the currencies. And these rates was set for different maturities period, so from overnight to um, 12 months. So these are the short forms money market instruments, so obviously for 12 months. And there are trillions of dollars of worth of securities in the financial markets who which are using these LIBOR's benchmark rate to set their own rates as well. There was some problems that started coming up in after 2008 financial crisis. We'll look into these benchmark rates once we go in the benchmark rate chapters in probably in the next lectures. But because of that problems, uh, the different government decided that we need to scrap these and create a new benchmark. So New York Fed has created a benchmark called SOFR. It's secured overnight financing rate, and this is used as a benchmark for dollar, and this is a secured benchmark because all the repos that is getting traded in the overnight market in US, those are kept tracked by the US Fed and published daily, and it takes generally the median, not the average as it used to be in LIBORs. And there are reasons for it, we will look into it later on as well. By median, not average. And this has become nowadays de facto. The SOFR is a de facto benchmark rate for US dollars. We have the Fed fund rate. These are the unsecured transactions that happens actually on the overnight basis, and Fed takes the average out of all these transactions. So what happens is that for Federal Reserve, so there is a requirement we talked about by the Federal Reserves or central banks of different organizations, countries. So to maintain those Federal Reserve, uh, at the end of the day, some bank will have a shortfall, some bank will have excess liquidity. Those who have the excess fund, they will try to earn interest on those excess fund. Those who have the shortfalls, they will try to get the fund from the market. And when these kind of transactions happens, there are certain rates that gets discovered, and Fed publishes these rates as well. These are called effective Fed fund rates, EFFR, and this is a volume weighted median of overnight transactions in the Fed fund markets. And this is a very key indicator of availability in the liquidity, availability of liquidity in the US banking systems. Though Feds are basically promoting the SOFR because this is a uh, secured uh, overnight financing rate, but Fed publish these data as well. And there is no immediate plan to basically stop that one as well. Then we have the interbank settlement and payment. Okay, so we looked into the who are the market players. We looked into the instrument which is used to trade. Now we need to look into the settlement and payment. So bank A sends something to bank B. How does this settlement happens? Because there are thousands of transactions going from this side to that side, that side to that side. So there are certain settlement uh, tools. One is issued by Fedwires, that is in US. So Fedwire is a Federal Reserve real-time gross settlement systems. So whenever bank A sends some money to bank B, it gets settled immediately. Then we have CHIPS, which is clearinghouse interbank payment systems. CHIPS is a bit different than Fedwire in the sense that CHIPS settles at the end of the day. So if there are suppose three transactions that has happened for bank A. So bank A might have taken money from bank B, bank A might have given money to bank C, or bank A might have done some transactions with some other sources as well. At the end of the day, all those transactions are netted, and whatever the net, whether it's uh, in negative or in positive directions, the chip systems basically help them manage it. And the benefit of doing it is that it helps you manage your liquidity a bit better. So that's the difference between chips and Fed funded. And generally, chips are used for large value international dollar transactions, dollar payment. So this is generally for international financings and all those things. Then we have the Target 2. Target 2 is a Eurozone RTGS systems, similarly like Fedwires, that is for US. Then there is a CREST. CREST is again the security settlements for UK. There are other global systems as well, SWIFT, CLS, and MAS. MAS is for Singapore. SWIFT is for Society of Worldwide Interbank Financial Telecommunications. So basically, this gives you a message, just like you get a message after every transactions in for the bank with the. Similarly, this is for international transfer of monies from one jurisdictions to another jurisdictions. Then we have the continuous linked settlement, CLS. So these are the different global systems through which basically settlements happen. Now let's look into the credit assessment. So we understood three very critical points. One is who are the players, what are the instruments through which they play, and how they know whether to give the money, how they know that they have received it, from whom they have received it, what securities they have received it, whom they need to pay that uh, basically fund. All those details we looked into. Now let's look into how they assess each other. So bank A does not know bank B, what's their situations each, right? So they need to know bank B's, right? To know that bank B, we have uh, there are two methods that is used. The one is the Camel's frameworks. Camel's frameworks used to be used earlier when there was not that much a technologically advancement, because some reasons there are a lot of unsecured funding that used to happen before 2000 financial crisis, and camels was the framework that was developed to assess the credit risk assessment. And once some banks qualify for that camels assessment, so in that case they can access this unsecured market where they do not need to provide the government securities or anything. They can just borrow the uh, funds from the market based on their credit assessment. And camels is an acronyms for C for capital adequacies, A for assets, M for management, E for equity, sorry, earnings, L for uh, liquidity, and S for sensitivity to market risk. So, capital adequacies, this is basically to understand if there is a loss, how much loss the bank will be able to absorb, short term loss. So, that's the capital adequacies that uh, generally try to give a view of how the bank will perform in the case of crisis. And there is a asset quality. So asset quality is the loan portfolios, basically how much the loan, what kind of loan that they have, what is the non-performing loans that the bank hold, is there any concentrated risk in any segment. So suppose if some bank, so you might heard about this Silicon Valley Bank, so there is a very concentrated uh, market for them, because that was the tech enables organizations that used to bank, generally bank. So there are concentrated risk. Then there is a management quality. What kind of management is there? So basically it looks into who is the board members, who is the CEO, what kind of products that they are launching, in which areas they are focusing on. So these kind of things get looked into the management quality reports. Then there is earnings. So in earnings there is a very generally they looked for consistency in the earning report. They looked into the net interest margin. So how's the net interest margin for the bank, because net interest margin gives a very good chunk of earning, and it gives a very good parameters to judge bank performance. Then there is a liquidity. So liquidity, we already talked about, like, so they need to maintain the LCR, liquidity coverage ratios. That is a short term, basically less than 30 days kind of liquidity. Here you need to maintain certain portions with the cash and T-bills. There is a net stable funding ratios as well, so that you need to maintain properly as well, because that gives you a long term understanding about how much bank will be able to overcome the stressful scenarios, like the economical downturn or something bad that is going to happen, and that happens. Then there is a sensitivity to market risk. So this basically looked into the changes in the market situations. So if there is a changes in the interest rate or currency exchange rate or other market factors, how these laws will impact the bank. So if the bank is highly exposed in some derivatives or some concentrated portfolios, then in that case, if there is a slight change, the bank will have a liquidity crunch. The bank will have a funding crunch, and they won't. So these way basically, these camel frameworks help a bank to understand the situations of another banks, and once they are satisfied with these ones, then they uh, get included in this unsecured market, and then only they will be able to trade in the unsecured market. So that used to happen earlier. Nowadays actually most of the central banks prefer that even the banks do the funding through secure lending frameworks, and we will look into this one next. So secured lending framework, basically we already looked into it, how it's done. It's done through repos actually. So uh, bank A submits some securities to bank B, bank B gives a fund to bank A, and this is how it happens. And so far is created, the so far benchmark is created based on these transactions. So this basically reduce the counterparty credit risk significantly. So there is a very less chances of default, and even if there is a default, you know that there will be recovery. So you will be able to recover most of the funds, or even all the funds actually, because this is a government backed securities. Okay, So in conclusions, we looked into the importance, the evolutions, and the risk management practices that is done by the bank. Now let's look into what we have learned so far. We learned that how the interbank market is a global market where the transactions happen through cross jurisdictions, and within the jurisdictions how it is getting managed, who are the market participants. We looked into that. We looked into the market instruments as well. What are the market instruments that is getting used in the money market? We looked into the benchmark rates, the LIBOR so far, and how the Fed fund rates are getting calculated. We also looked into the settlement and payment systems that is getting used, and we also looked into the credit risk assessment frameworks that is used nowadays. Actually it happens on secured lending, so there's not a lot, but still bank needs to do the credit assessment even if there is a secured funding. So what happens is that even if it's a secured funding, if some bank has a very good credit quality, there is a very less haircut. We mentioned about the haircut, right? And if some banks are not that great credit assessment, then in that case there will be a higher haircut. So suppose if two famous very large corporates are doing a transactions between them, then in that case both of them knows that these are too big to fail, basically kind of a banks, and they won't fail. So in that case they lend it. So suppose if bank A need $100 million and bank B will charge, okay, give me 100 million of securities and I will pay. And if some banks which is a small bank, they do not have that kind of credit risk profile, then in that case they will charge a higher amount of security. So suppose bank A uh, is a small bank and they need to provide a collateral. In that case they need to provide 105 million dollar of collaterals as a government securities. So credit risk assessment happens in the secure lending frameworks as well, but in a different way. Okay, that's it for today's. We will be looking next. Uh, we'll be looking into the benchmarks, uh, how it has evolved and where we are. We looked into it a bit today's, but we will look into it in a much more details. For the quiz, uh, the link is in descriptions. Do provide your comment and suggestions, and if you want to follow it, uh, then you can follow it on the basically this blog. I have provided a link over here, and it will be provided in the descriptions as well. Thank you.